A lot of people think that the Fed has been successful in reducing inflation because, it went from 9 down to 3 will complete the journey, right? Because we're almost there, but we're actually miles away because the main reason that you saw that big drop from 9 to 3 was a collapse of oil prices and other commodity prices that was basically brought about by a surge in the dollar where currency traders were starting to price in all the rate hikes. So the Fed actually already got all the bang for the rate hike buck. Now, oil prices are headed back up. We're back above $81 a barrel today, headed higher. Other commodity prices as well. The dollar has peaked, I think, and is declining. So the headline CPI probably has bottomed out in the low 3s, and now it's headed back up. Meanwhile, if you look at the core, which is what the Fed claims is more important anyway, that's still around 5. And the decline in the core is far less than the decline in headline. I mean, it's barely gone down, despite the fact that we've moved interest rates from 0 to 5.5. So if the terminal rate is 5.25, 5.75, 6, that's not much from where we are now. And so why would that actually do anything when we haven't seen a meaningful decline? And also, people forget that these rate hikes are in and of themselves price hikes because it's the price of credit, the price of borrowing. And so every business that has debt is now having to pay more to service that debt, whether it's your landlord who's got a mortgage, a commercial mortgage that's resetting, or it's a business that has borrowed money to purchase plant or equipment and has interest rates to pay. That's just like labor costs or raw material costs. It's another cost of doing business that is rising. And so businesses then try to pass on those higher costs to their end consumer with higher prices. So as higher interest rates continue to work their way through the cost structure, you've got more upward pressure. So I don't see how the Fed has really accomplished much of anything. And also, if you think about the way rate hikes are supposed to reduce inflation, and Powell will admit this when he talks, they're supposed to reduce aggregate demand by making it more expensive to borrow so that people will borrow less and they'll spend less, and that'll, slow the economy, the way they describe it. But none of that is happening. Credit card debt is at an all-time record high. The government budget deficits are skyrocketing. We're on a run rate now of north of $2 trillion a year in deficit spending, and we're not even technically in a recession yet. I mean, normally when you're in a recession, the deficits double or triple. And so, but they're already enormous. And so even though the Fed has been making credit more expensive, it hasn't slowed down demand for borrowing. Consumers just are paying the higher prices, borrowing the money anyway, and spending it. So all that spending is still driving prices higher. So I don't think the Fed has made any headway at all. But that's why the whole thing is ridiculous, because when they say 2%, they actually mean 4%. Because if we measured prices today the way we did it in the 1970s, 2% would be 4%. And in fact, all the years where the Fed claimed we didn't have enough inflation, which was all BS to begin with, because it was below its 2% target and we needed more inflation, we were never really below that target. We were above it the whole time. It's just that they were measuring it improperly. And the reason they did that was because they wanted to justify printing all this money to stimulate, the economy and to finance deficit spending and, to take the politicians off the hook from having to make the difficult political choices that may have jeopardized their reelection, because absent the Fed printing all this money and keeping interest rates artificially low, politicians would have had to have cut spending. And so that means that they risk losing the votes of the people who were losing their money. And so nobody had to do this because we were able to create all this inflation. But now the inflation chickens have come home to roost. And, this is a huge, huge problem that's insolvable and is going to get worse. And ultimately, what's going to happen, if the deficit spending continues, which it will, the Fed is going to have to choose between a massive increase in long-term interest rates, far beyond what we've already seen. I mean, we're at, 18-year highs or something like that, 16-year highs. The yields on the 10-year, out to 30 years are, 4.2-ish. But if these deficits continue and the Fed continues with quantitative tightening, these yields are going to move up to 6%, 8%. I mean, they're going to go substantially higher. And of course, that's going to have a profound effect on the financial sector, on real estate. I mean, the whole economy is ultimately going to collapse when we get a return to those type of rates. In fact, everybody believes that we're going to go back to the really low rates that we had for more than a decade. That's never going to happen. But not only are we not going back down to those super low rates, we're actually going to historically high rates. I mean, right now, they're not even average. They're still below average. But I think what the Fed is going to end up doing to prevent that from happening is reversing this quantitative tightening program that has so far shrunk the balance sheet, close to $8 trillion. It was almost $9 trillion at the peak. So we're getting close to $1 trillion decline in the balance sheet. But with these deficits, the way they're going, the Fed's going to reverse and go back to QE, and the balance sheet is going to explode. In fact, if you look at interest now, interest payments on the national debt, they've gone from a few $100 billion a year to $700-800 billion. I think right now, interest on the national debt is the third biggest expense. First Medicare, then Social Security, then interest on the debt. Interest on the debt is bigger than national defense. If you can believe that, as big as defense is, interest on the debt is bigger. But interest is growing really exponentially, because not only do we have to pay the extra interest on the $2 trillion a year that we're borrowing, more than $2 trillion, but every year, let's say $10 trillion worth of debt matures and needs to be rolled over. Well, it's maturing with a coupon of maybe 5 basis points, 20 basis points, maybe up to 100, 150 basis points, depending on the maturity. But most of it is real short term. Most of the paper that's maturing, the Fed borrowed the money a year ago, 2 years ago. Well, where were rates back then? They were practically zero. Now they're 5. And so as all this debt matures and has to be refinanced at, 5 plus, if they want to do it with, 6 month, 30 day, 1 year, right? If they want to go all the way out 10 years, well then, but it's still in the 4s compared to where it is now. So the costs are skyrocketing. I think that by the end of the year, we'll be at about $1 trillion a year in net interest payments. And probably by the end of next year, we'll be at 2. And I think interest on the national debt will then be the single largest expenditure of the nation, bigger than Medicare and Social Security. And in a few more years, it'll be bigger than all those combined, right? Because what happens if the national debt gets to 40 trillion and interest rates go to 10%? That's $4 trillion a year in interest. I mean, we're going to be at 40 trillion national debt in a few years. We're at 30, almost 33 trillion now. We're adding more than 2 trillion a year. So in 3 or 4 years, we're at 40 trillion. And by then, all that low yielding debt will be gone and it will be replaced by much higher yielding debt. So maybe it won't be 10%, but let's say it's 7 or 8%. You're still looking at $3 trillion a year in interest payments. I mean, this is unbearable. We can't afford it. Obviously, something's going to break before we get to that point.